what I do think is the general tendency of corporations is you throw away your money to the investors, and the investors buy the index, and that's how they keep their economic wealth intact. And that's good for the investor, right? That's why Harvard Endowment and Yale and Harvard and all of these large institutions, that's why they have a 500-year life expectancy. They just buy a capital asset like real estate or equity. And the reason that your favorite company lives for 5 or 10 or 15 years and goes bankrupt is because they don't have any assets, right? It's like, again, I've said before, they're like type 1 diabetics, right? They can't store energy. Bitcoin is insulin. It's insulin to the type 1 diabetic, right? If you're a company, you need Bitcoin. It's like your insulin. All of a sudden, you can store economic energy. You're not doomed to decapitalize yourself. Our company's raised a lot of money. We raised a ton of money via equity issuance, a lot of money by bonds, and in the last 12 months, we've really rotated to raising capital via preferred stocks and preferred credit instruments, and that has taken off. Now, what is the Treasury business model? We're really financial engineers, right? We engage in financial structuring or structuring of we're a structured finance company, if you will. And what you can see here is the raw asset is Bitcoin. It's got a 51% ARR and a 43 vol over the past 30 days. If what you wanted was that, you could just buy it. But what we've done is we strip the volatility and the risk off of the asset. So we strip a bunch off with Strike down to 29, then 18, then 15. And Stretch, we stripped it down to 8% in the last 12 weeks. Stretch today, it's targeted at 100. It traded between 96 cents and 107 cents. But it's down to trading plus or minus 4 cents or 5 cents. If that trend continues, the vol on Stretch will go to 1 or 2. And so what we're really doing is stripping the volatility off of the pure economic asset. There's conservation of energy in the universe. Where does the volatility go? It goes to the equity. If I actually convert 50% a year performance into 11% performance, where's the extra performance go? It goes to the equity. So what we're doing is fairly elementary. We're just stripping the performance and stripping the volatility and stripping the risk, and the extra risk, the extra performance, the extra volatility goes to the equity. And that's why a business that has $70 billion in digital capital can create $3 billion of very, very low volatility credit. It's not that different, again, to take a barrel of crude oil and you take crude oil, if you distill it to the highest, most distilled form, you have kerosene. Kerosene is jet fuel. Kerosene is rocket fuel. Now I'm going to make a joke. If you study the history of science, it's full of examples of people that saw breakthrough technology, but they used the technology the wrong way because they were conventional thinkers. The idiom is repaving cow paths. It's like you invent concrete and you could create a 6-lane superhighway and the car could go 90 miles an hour, but instead I take the concrete and then I put it over a cow path that was meant for a cow that moves 4 miles an hour. And now I've got a paved cow path where cows can now move 4.5 miles an hour. You got no benefit from the technology because you used it the wrong way. Now I'm going to give you an example here. John D. Rockefeller, distills kerosene, and you're in the horse and buggy business. So what do? Well, you create a kerosene lamp, and you put a kerosene lamp in the back of the horse and buggy so that your customers can travel across the country by horse and buggy with a kerosene lamp and read a book. Or you put a kerosene heater in the back of the horse and buggy, and you brag that now you've got a warmed horse and buggy, and you won't be cold while you're in the horse and buggy. But a dude like Ford comes along and thinks, well, maybe we'll just create an automobile and we'll drive with gasoline. Or maybe Boeing comes along and creates an airplane and we just fly across the country. So there's a compelling thing to do with the kerosene, like rockets and jets, and there's gasoline and there's cars. But there's also the trivial application of the technology, which just makes the horse and buggy 1% better, and yet you'll have the greatest business people of the era made all their money with horse and buggies, and they're going to grab the kerosene, put a kerosene lamp in the back of the buggy, and they're going to declare that they've used the technology for the good of their shareholders. And what I would say here is you just have to think different, and you have to think much bigger with regard to what you can accomplish here with this technique. What we do is we accrete Bitcoin per share, right? So our equity investors want more Bitcoin per share. We started with 56,000 Satoshis a share, and we added every single year. We added about 74% more last year and 26% more this year. There's a lot of ways to do it. You can sell equity, you can sell bonds, you can sell preferred stocks, you can sweep cash flows. This is a snapshot of the company's balance sheet. In essence, we're 1.1 levered, we're 1.3 times amplified, and we have 84 years of dividends. You know, when Lehman got in trouble, they were 30x levered, and then they went to 50x levered. At one point, they had 15 billion of equity and $750 billion of assets. Right, so I get preached to a lot by finance bros that want to tell me don't get too levered, but what I want to point out is we're not even 2x levered. And literally the leverage is going to 1. That debt is going to go away. So the interesting thing to do here, of course, is to use credit that is equity to amplify your performance, because if you do that, you can do it without credit risk. And it's very interesting. Our future is in credit issuance, right? What I said, the day you were born and the day you figure out why. Why are we here? We're here to sell digital credit. And the product is the credit. And so we just got a credit rating from the S&P. We're the first digital treasury company to get a credit rating. It's pretty much the worst credit rating you could justify. We're starting at the bottom and we're crawling up. And it's predicated upon the Basel Accord, which it suggests that Bitcoin is worth zero. It's zero capital. So you have a banking establishment that values Bitcoin as zero, but you have the marketplace that thinks it's worth $70 billion. Over time, we will rectify that, just like with accounting standards, we were able to rectify that. And as that gets improved, then our credit ratings will move up. But the significance of a B credit rating is that instead of having access to 2.8 trillion worth of capital, you now have access to another 4.9 trillion. So we 3x the addressable market for credit instruments that we're selling. And the most important thing is to allow fixed income investors and insurance companies to allocate to that part of their portfolio. So we thought that was auspicious. Our ambition is just to continue to improve the credit rating until we're an investment grade issuer of credit. And that takes me to the product, right? The product is digital credit, right? Did it exist a year ago? No. We invented it. Necessity is the mother of invention. Why do we invent digital credit? Because traditional bonds are too risky. We tried traditional bonds. We tried asset-backed borrowing. We found that either the bond market wasn't large enough or wasn't stable enough. And pairing traditional short-duration credit instruments like bonds with an asset like Bitcoin, which is highly volatile, creates a very dangerous situation where you might get forced liquidated, or you might get yourself into a credit crisis. That's not good for the equity. And so over time, right, this is the conundrum that every financier has, right? How do you go bankrupt? You lend long, you borrow short, right? A bank has overnight deposits and puts out 30-year money, and then people want their deposits back, and you can't call the loans, and so you get a run on the bank. You know, when Lehman went out of business, they were borrowing $700 billion for 15 days, and then they were invested in mortgage-backed securities and real estate with a 5, 10, 20-year duration. So obviously you don't want to mismatch your durations. If your goal is to buy an asset, what is Bitcoin? Bitcoin is a 10-year duration asset. If you're going to buy it, a normal time frame would be 10 years, 120 months. So what you want is a duration on your liabilities that is comparable to that duration of Bitcoin. So how do you get to 10-year duration money? You can't do it with 5-year loans. So we started thinking that what we'd like is to get 10 to 20-year duration, and the way to get that is with preferred equity. And so we went to the market and we thought we're going to sell preferred equity, and we found that the market wants a higher dividend yield for preferred equity than for bonds. And our first reaction was, oh, that's bad, that's a bug. And then after a while, we realized that's actually a feature. If we're paying 200 basis points more than we thought we should pay, then our credit just became the highest yielding credit in the world. And when you flip it from a bug to a feature, then you start to see something different, which is the credit that we issued from 2020 to 2024 was tactical credit in order to amplify the equity. We were trying to. The product was the equity, and the credit was the tactic. And what happened in the last 12 months is an inversion of the business model, where we realized that the credit is the product and the equity is the afterthought. The equity follows from the credit, and the real product is, what if I gave 10% dividend yield to 1 billion people tax deferred and stripped the risk off it? Well, that's a product that would appeal to everybody, but maybe more interesting, that might be the best product in the world. Say that again, that might be the best product in the world. If you can give someone 600 to 800% of additional yield over the risk-free rate in a non-volatile instrument in the currency of their choice, you've created maybe the perfect product, because that's what everybody wants. And we tripped over that. And we started by doing a convertible preferred strike. We over-collateralized it. The effective yield was 9, but we realized that it was going to be tax deferred. So the actual adjusted yield goes to 19.7%, which is just off the charts. And then we did another one, Strife, and here I'm describing Stride. Stride's the junior credit instrument. The effective yield's 13%, but it's a ROC dividend, which means you have tax deferral to it. So the actual effective tax equivalent yield is 21%. Okay, it's the crappiest thing in the credit stack. It's the lowest grade one. It's 4.2 times over collateralized. There's not an investment grade company that you can find that's 4 times over collateralized in the conventional, traditional credit market. So we actually have something which is thought to be junk bond or distressed debt, but it's actually an investment grade risk, right? Once you start to study it, and that's again a profound insight and a breakthrough. And so, depending on how you look at it, it's anywhere from 2 to 3 times better. Then we created the senior instrument, which is 7 times over collateralized. That kind of sets the cost of capital, and that's 9% effective yield and about a 14% tax equivalent yield. And then we ran into a brick wall because we wanted to do some credit issuance in Japan and Europe, and we were running into some impedance. And so I thought, what can we do in the US? And we started thinking, and we realized that what we hadn't done is a monthly short duration money market instrument. And so a lot of people complain. They're like, well, we want monthly dividends, and we don't want volatility, and we want no principal no principal variation. So we started thinking, how can we do this? And we used AI. We designed this product, Stretch. We took it public in July. It's the biggest IPO of the year. By the way, we've done 5 IPOs this year. 5, right? I don't think anybody's ever done 5 IPOs. The joke that I made is I came up with $1 billion idea in my life, and then I spent 20 years trying to find the second $1 billion idea, and I couldn't find it. And then from the point we found Bitcoin, we found the second, the third, the fourth, the fifth, the sixth, and we started finding $1 billion ideas every 8 weeks. And that's what happened when you combine digital capital with digital intelligence in the right world. So this one came along in July, and the idea is basically you set the dividend every month and you try to stabilize the principal at 100. And it was well received. And then the deal we did last week is we launched a version of Strife. We launched a perpetual 10% yielding instrument in euros in Europe. And it was about 700 million US, about 620 million euros. And right now it has an effective yield of 12.2%, but a tax equivalent yield just south of 20% if you're a 37% taxpayer if you live in Florida. This is how Stretch has seasoned over the last 12 weeks. So what you can see is it started at 90, we jacked the dividend, and then we took it up 25 basis points twice. And then over the past 8 days, it locked in. Today, it traded plus or minus 5 cents. And today, if you look at your quote, it closed at $100 and 0 cents. And it was traded with 1 penny spreads. You know what we told the market is we're not going to sell it below 100. So if someone wants to offer it to you below 100, you should probably buy it because we're going to get it to 100. And then we're not going to let it drift up above 100 either. So this is our most aggressive piece of financial engineering, because what you see represented in Stretch is us saying we're going to strip 120 months of duration down to 1 month. We're going to strip 50 vol down to 1 if we can get there. We're about 8 now, but probably we're 5 or 3 in the next week or so. We're going to strip that to 1. We're going to convert the basis currency from BTC to USD and take away the currency risk. We're going to take out the delta, and we're going to over-collateralize it 5 or 6 to 1, which is the same as stripping away about 98% of the risk from the instrument. And then we're going to hand that to you as a high yield bank account. And then we're going to take it public, give you a 4-letter ticker, and let you trade in and out of it in the market, right? And if there's a kerosene for Bitcoin, this is the kerosene. This is the jet fuel.